If you've listened to financial podcasts or read investment blogs within the last 2 years, you know you need to invest. You know that building wealth is important, that assets put money in your pocket, and that financial freedom is on the other side of investing. And that's great. But what does that look like in real life? Well, that's where we come in. My name is Onese Naholo, and today I'll have a practical conversation with an expert about investment portfolios, what they are, and how to build them from scratch. With me is Emmanuel Ugoke. He's an investment and business professional with a background in economics and accounting. With over 5 years of industry and market experience, he's a chartered accountant, a CFA candidate with certifications in financial modeling, business analysis, and valuations. He's passionate about business management, capital allocation, and providing financial insights. When he's not traversing the markets, he's swimming, cycling, watching comedies, and planning his return to Kung Fu. Emmanuel, welcome to the Market Lens.
Odosei, thanks so much for this introduction. And
Kung
also
Fu.
your intro, I liked it. Financial freedom is on the other side of investing. That's fantastic. And I'm so happy to be here today.
Thank you.
Thanks
Thank
for
you
having
very
me.
much.
Thanks.
All right. Before we dive in, now we're going to talk about the entire process of building a portfolio from nothing, right? You have nothing and, you know, boom, magic. You have a portfolio now. And so we're just going to walk through that magic. But before we get to that, can you just tell us about your approach to portfolio building and what you've learned over the years of your career?
Yeah, this is very interesting. Because I think, starting from portfolio building, it's actually about controlling the risk of your assets and actually getting to financial freedom and staying free in that space, because you can get there and somebody can pull you back into the whole struggle. And coming to your question, what I have learned over time is that um the start of it is not to spread yourself too thin, because I know the concept of diversification is out there and everybody's singing it. But I think it's more going in depth in a particular sector, say banking, like Tony Lumelu did,
Mm.
in the cement space, like Dangote did, before you spring up, then spread your wings. So for me, I'll call that depth alpha. You
Oh,
know,
okay. Depth alpha.
so you get into your alpha space, and if you are a salary earner, your alpha can also be investing in yourself so much that you earn enough returns or enough salary that you can slice and dice into asset classes. So in my experience, portfolio building, takes a bit of time. Check Dangote's history,
Hmm.
check Tony's, check Elon, check Warren Buffett, check the other very rich persons that have gone on to the other side of financial freedom, as you termed it.
Yeah.
They keep investing because it's a lifelong journey and it's a habit. And consistency is key,
Mm.
very key.
There are a couple of things you said that I like. First, of course, is depth alpha. That's actually the first time I'm hearing that. And I mean, if I'm putting it in layman's term, now correct me if I'm wrong. That basically means focusing on your competency, right? Your circle of competence. I know you mentioned Warren Buffett, and that's something Warren Buffett said, or was it Charlie Munger? One of the two. That said, focus on your area of competence. Another thing you said was that building wealth takes time,
Yeah.
right? And I know people today were like, okay, you know what? I want to build wealth today. This is March, right?
Yeah.
Okay, so by August, do you think we would have built
Okay.
enough wealth?
Okay, let's split it, right? So there's a difference between having cash in your bank account
Mm.
and being wealthy, right? So when I say you are wealthy, it means you are protected from all angles. For instance, you can have money. Had it been someone, God forbid, had money in Heritage Bank
Oh,
and it goes bust,
yeah.
you know, you were financially free. Now we are here. But wealth is robust. wealth is controlling, using correlation to arrange your wealth, to arrange your finances. So how we define wealth is having assets that you can leverage on. For instance, if you have real estate, you can borrow with that real estate to get more real estate. If you have stocks, you have shares, those stocks can appreciate. You can sell off, take your capital gain, and use that money to invest in other things. You can have dividends accruing to you from those assets. You can also borrow on the back of those assets. You can put together. So wealth for me is creating a platform, creating value that you can leverage to create more value, not just having cash in your bank account.
I like that. Because I feel that usually people that are rich
Yep.
tend to have more cash than people that are wealthy.
The thing is that cash is actually part of the portfolio. Because of course, as you're building wealth, you need to live. It's only the living that can cross over to the other side. Financial freedom. So
Actually, that's true.
you need cash to move around.
That's true. All right, so let's because I know we said a lot. We said real estate, we said stocks, we said cash, we said portfolios. Let's bring it back.
Okay.
I start from the beginning.
Okay.
All right.
Okay.
Now for someone who has never invested before,
Okay.
right? A newbie, right? And what are the first steps? Because I mean, even I know that if you never invested before, the first step isn't invest. It's not go and buy this.
Yeah.
Right? So what's the first step?
Okay. This newbie has at least a source of income, right?
Okay.
Okay, that's background.
Okay. So
you can earn.
So that should be the first.
That's
if you don't have a source of income, invest is not for you.
You need to get to alpha.
Okay.
You need to get to alpha. Okay. So how I think about it for a newbie, fresh out of school, maybe in NYSC.
Yeah.
So if you're in NYSC, in there you'll be earning like, I don't know, whether it's 35 or 77,000 naira now. I don't know, or the minimum wage. But at that stage, there are two things I think will be on your table. Are you trying to get a high-paying job, or you're trying to start your own business? Now, are you trying to build your alpha in terms of yourself and the services you offer? That is like getting a job. You are the service you offer. Or you're trying to build a business that you are going to run or hand over to managers and even list on stock exchange. So in either of these two, let's say you are trying to get a paid job, so you want to invest in yourself. So with that 70,000, I'm not sure it's the time to start investing heavily, right? Because investing in yourself in developing skills is a form of investment, because you are building depth in your own alpha, increasing your skills, getting certifications. And it's not about getting certifications, it's about applying them. So when you learn something, you apply it in the real market. So that's where it starts in NYS. Then if you're building a business, you have to, of course, hone your skills in that business, understand the kind of space you want to venture into, then create a source of income from there. So more of the money that NYSC first candidates or the youth copper would have would go into more of self-development and creating your own niche. So at that level, if you're saying you want to build a portfolio at that level, I think your portfolio will be more skilled to building yourself or building the knowledge base to build your alpha. Then when you go past that, let's say you've got your alpha, you've got your business, you've got your job, then you start earning. Then I think we can have this conversation. So let's break it down. So building a portfolio is about putting together assets that don't behave the same, in the sense that even if the Nigerian economy is going bust, trending downwards, you still have some asset classes that can give you money to maintain your lifestyle.
Okay, so right. So the first step is you need to get a job, right? Have a source of income that is a consistent income.
Yeah.
Is there a minimum cutoff to that income? Where if you know that, okay, if you earn below, because there are people that are listening that are not, and they're doing their NYSC, right?
Yeah.
So is there a minimum level? So if you know you earn below, just go and buy food or something. At the end of my head, then you can
Okay.
think about investing. Is there like a
Yeah.
minimum
No,
in
okay.
Nigeria today?
In Nigeria today, that question is very nice because there are some stocks that you can buy for less than 1 naira. ICO insurance was once trading below 1 naira. It was 0 point something. And the funny thing is that these small stocks are actually high yielding because if 0.5 goes to 1, that's 100%.
Yeah, but then what are the possibilities that 0.5 go to 1?
Well, ICO insurance has moved to 1 now, so there's a possibility. So in
Okay.
terms of minimum, direct to your question, minimum earning capacity, I don't think. Well, once your income can take care of your basic needs and you are not begging, then the leftover or the one on top of it will have to go into investing.
But then I don't think that's a bit subject to lifestyle, right? Because there's thing I heard one time when it said if you earn below a certain threshold, I think in the US the threshold is like $100,000 per
Okay.
year. I don't know what it is in Nigeria, but if you earn below, the best thing you can do if you want to start making more money isn't to invest in assets. I mean, you can always invest in yourself, but you need to invest in assets, but to make lifestyle changes, you know. So maybe if you
Okay.
drink coffee every morning, maybe don't drink coffee, maybe don't eat out. Because earlier you said if your salary is able to, afford the basic things for you, afford, at least your lifestyle. So is there a possibility that actually your level of lifestyle might be a barrier that you need to overcome before you even start investing?
Okay. Let's have it this way. So if your lifestyle as an investor might you need to adjust it, right? You
Yeah.
need to mind the things you buy. Because if you start looking at things like if I want to buy this item, how many percent of it is my salary? If you look at it from that perspective, and if you get how many percent it is, you can understand how many days you worked to earn that thing.
Oh, so you're looking at the price of things in terms of the time it
The
takes.
time, because time is the real currency. Time is the real currency. And at that point, if your earning is not as big as it ought to be for you to invest, you need to start deepening your alpha. You need to start investing in yourself and increasing your earning capacity. If you're a business person, you need to start investing in expanding your business, more customers, what can you leverage on the assets you have at the business at the moment? Can you leverage on it to get more money, to get more assets and expand your business? The current role you are playing in your firm at the moment, if you look long term, will that role get you to where you want to be? Is there another role we are thinking you are capable of? Then, if there is, have you started investing in yourself to be able to perform that role? Because nature is very nice. Because if you think of something, it will come to you. But the question is, will you be ready when it comes?
Okay.
So instead of trying to live up to a certain lifestyle, I think the focus will be deepening your alpha and trying to get knowledge of the financial markets and other ways that you can make money.
I like that because at least for the past like 5 minutes, some of the things we've talked about aren't even completely financial. You know, because it's easy to think, okay, so if I'm building an investment portfolio, a financial portfolio, then everything is financial. It's just about saving money and doing this with money. But then some of what you even talked about is like a mindset thing. Because looking at how much things cost on the basis of how much time it takes you is a mindset shift,
Yeah.
right? So the first step, would you say the first step to building a portfolio is mindset shift? Looking at yourself, okay, what are things I need to develop, in order to increase my wealth? Okay,
Yeah.
I like that. For the people who really don't know, right, can you just go into what a portfolio is? What's a portfolio? And why are we bringing up investment portfolios when we're talking about making money and being financially free?
Okay, so portfolios are combination of asset classes. Now, what makes a portfolio really a portfolio is that it's not made up of just one asset class, but different asset classes. And if I'm to go a bit deeper, a portfolio can be well diversified or it's not well diversified. When it is well diversified, it means the asset classes they are not correlated, which means they are not behaving the same way.
Yeah, you said that earlier. You said assets that don't behave the same way.
Yes.
So digressing just slightly before we come back. How do you know when assets behave the same way?
For instance, even in Nigeria at the moment, when they are increasing NPR, everybody knows NPR these days. So when
Monetary
they're
policy rate.
okay, when they're increasing NPR, the banks are smiling. They're making more money
Hmm.
because their business is skewed towards lending and borrowing, and NPR is the base.
Yeah.
But the manufacturers that are expanding based on borrowing from the banks to buy more assets, they are not smiling because the cost of borrowing has gone up,
Mm.
which gives you two kind of equities, two companies, two sectors, and they are not correlated, significantly. Even though they exist in the same economy, there's a level of correlation, but it's not significant because that gives you a distinction because one is smiling, one is not. Which means if NPR starts coming down, you know where to go because the manufacturers have more money to spend, they have more capacity to expand, so they make more money. And the banks, their net interest margin will start coming down.
Okay.
So
So
that's
you could have assets that are literally the same class of assets but are not
correlated.
correlated. They don't behave the same way.
Yes.
Okay. So that's all right. So back to portfolios.
Okay, yeah. So on portfolios, it's about so building different asset classes. So when I say asset classes, we can have equities. So equities is more of buying percentage holding in a company. So you're part of the shareholders.
Yeah.
Then we have fixed income. Fixed income is more of lending to corporates so that they can expand through bonds and other instruments. We have alternative investments. That's where you have the private equities, the commodities. Even in those, we break all those things down. So these are then you have cash and cash equivalents, of course, in the portfolio. So all these make up a bulk pack for a portfolio.
Okay. All right. So now we know what a portfolio is, right? Um, Now some people say before you start investing, and I've read this, before you start investing, you should take care of any debts that you have, So you should pay off your debts before investing. I don't really want to go too much, into debt, but if say I have like a debt,
Yeah.
right? Can I start investing while servicing my debt, or does it maybe depending on the size of the debt? I have to actually pay off my debts like, the regular investment and finance blogs say
Yeah.
before, and I'll look into investing or building a portfolio.
Oh, nice, nice. So there are different kinds of debts, right? If the debt you have gives you opportunity that you can pay in 1 year's time, maybe you borrow from a friend, for
Okay.
instance, you can do fixed income, you can do T-bills. T-bills is backed by the federal government, so this has a very low to zero level of default. So that in 1 year's time, oh, that's assuming if you have the money at the moment, right? From day
Oh
zero.
no, I think I might be a bit confusing. So
Okay.
if like I have a debt, like I borrowed money
Okay.
and I need to pay back the money. But at
Okay.
the same time, I also want to invest or can build a portfolio. Aha. Should I say, okay, let me calm down and pay back this person first? Or should I say, okay, you know what, the money that I've paid you, let me split it in half. Then use half.
This you said now reminds me of what Trump said one time. When Trump was struggling, Trump was down. He was owing people about $6 million or $6 billion, but a huge sum. So he was walking down, according to him, walking down the street with his wife, and he pointed out to someone on the street, a beggar. And he said to the wife that the beggar is actually richer than me. The beggar is probably on zero, but I'm on negative 6 billion or
Mm,
whatever the amount is, which means before you can even start investing, start building wealth, come out of negative because wealth starts from zero up.
oh,
So pay your debts.
pay your debts. Okay. All right. So now going into if I want to build a portfolio, right? What are the considerations? So now we've talked about mindset,
Yeah,
right?
yeah.
You have to build the right mindset. You have to get to at least zero, so no debts. What are the other things that I need? Maybe in terms of risk or time horizon. Earlier we said building wealth takes time.
Yeah.
How much time? You know, but so that I can gauge, so I know when I'm going to be rich. So, so things like that. So what are some of the other considerations, around building a portfolio when setting a goal of how much should be in my portfolio? How much does it make sense to want to put into my portfolio? Right? How much should I expect from my portfolio? Should I expect money from my portfolio?
Yeah,
Things like that.
yeah.
So so let's start with the first. Let's start with one to break it down. Um, how much should be in my portfolio? Let's start with that.
Your portfolio, how much will be your portfolio is dependent on how much you earn, your disposable income, um, less your expenses, monthly expenses for a salary earner, for instance, and the amount of money you can invest without impacting your current activities. Now, where should that money be is a function of what's your risk appetite. So, how much can you lose at the moment?
Yeah, this is Nigeria. I can't lose anything. Sorry.
So, okay.
But that's like a thing because people don't want to lose money, right? And so I know for a fact that people have different what you call risk appetites, the amounts they are willing to lose.
Yeah.
So how is there a difference between, at least as a professional in your line of work, how do you help clients come to, should I say, a realization of how much they are willing to lose, or tell them, okay, based on what you want to achieve, this is how much you should be willing to lose. So how do you go about that risk? Getting clients to, one, understand the risks involved, um, come to a conclusion of, or discover their risk tolerance, and accept the risks that they will have to face.
Oh, okay. Okay, so in that, so if you are a client coming up to understand your risk profile, first of all, you have to get knowledge of the assets you want to invest in. For instance, someone in his early 20s can afford to invest in equities and all those because technically they are perceived to be able to accommodate more risk. They can lose the money, but they still have time to get it back. How do you understand how do you convince a client that wants to build wealth that he's going to lose some part, quote unquote? So it's building wealth comes with gains and losses. Dangote, for instance, tried banking.
Oh, he did.
Yeah, he tried banking. It didn't work out very well. So he left banking and
It's a good
focused
thing
on
he
his
did try.
alpha.
It's a good thing he did. But yeah.
It comes with, so, and it's a risk return kind of thing. So if you want to make it big, you should be willing to risk big. If you want to stay stable over time, then stay stable, but your earnings will go as big. And these things have asset classes. And also for a client to understand his risk appetite, even the constructing the portfolio have to come from that. It depends on the age of a client. A client that is very close to retirement, should be playing more, like 70 or 60% of his portfolio in equities, because it's close to the time he has to be stable. A client in his 20s, like I said, can afford to play in the equity space. Then, aside from age, it's about personality.
Okay.
Then come to talk about risk neutral, risk averse, and risk loving. Someone is risk loving, but the person gets excitement from taking the risk regardless of the return. So you can tell the person that you have a certainty of taking $50, right? But if you choose, okay, option two, A and B. Option A, if you risk it, you have 50% of getting $50. Option B, if you don't risk anything, you still get $15, right? A risk-loving person will go for option A because he drives more satisfaction from the fact that there was risk in the whole conversation. So you get it.
So even if there's no return,
Hey, well,
high risk, no return.
no, there's always return somewhere.
Okay.
There's always return somewhere in it. So we can have a risk neutral person is about the return. So if you tell a risk neutral person, take 50% risk and you will get 100, or no risk and you get 50. The person will take 50% risk for the 100. Because the person is looking at the outcome, not necessarily the risk, but the outcome. But if you tell a risk averse person 50% risk to get 100, or a certain 50, the person will go for a certain 50. And if you're that kind of person, it means that in constructing your portfolio, we have to weight the fixed income side of your portfolio more than the other risky side of your portfolio, like equities and the alternative investments.
Earlier, you mentioned, at least from what you said about risk, there were three distinct profiles that that I got: the risk loving profile, the risk averse profile, and the risk neutral profile. Right. So now, from what you said, it seems as if you are young, you are more likely to be risk loving. If you are old, you're more likely to be risk averse.
Well,
Is that always the case? I mean, have you in your career seen a 70-year-old who was like, what? I don't care. Let's do it.
Yeah. So it happens. It happens. But on the average, and just like we said, most likely,
It's like
not exact, but the average. But the defining factor is just what's the person's personal makeup. If your personal makeup is that you look at the returns, you don't care about the risk, you just want to get the goal, you don't care about the risk, then you are risk neutral. But if your focus is on, I just like my adrenaline up, I like the drills, I like to take more risk to get more return, then you are risk loving.
Yeah.
But if you are about, I just want a stable lifestyle, no dramas, just get me this certain return at a very low rate. So you don't like, you prefer a certain outcome, certain without risk, then you are risk averse. So you can check yourself, understand your own risk profile.
Okay. Now, does time horizon have an impact on risk profile, or have an impact on your portfolio structure based on your risk profile?
Yes, yeah, it does. So time horizon, let me take it from age.
Okay.
So if someone is 20, the person has technically enough time to recover from any financial shock. And also the person needs more money to build his life.
What do you mean by that?
Because in Nigeria, you need to build a house, you need to take care of a family, if you're a guy, and you also need to even enjoy life generally. And cost of living is not coming down.
Yeah.
But if you're in your 70s, 80s, you probably just need something stable. You've done the whole heavy lifting. You're in a stable state. That's the assumption. So you need more stable kind of investments. That doesn't mean you can't still get into the ranks of equities and alternative investments, but you can stay cool more on the fixed income side.
Okay. So time horizon. Right?
Yeah.
So the younger you are, the more time you have, and you can really go for more aggressive, approaches. While if you are older, All right. So now that we've talked about the, everything before the main, or is there any other thing that needs to that I have skipped?
I think we are home and dry.
All right. All right. So now let's go to asset allocation. Right. So for people who don't understand asset allocation is just basically apportioning parts of your fund or your investment, your cash you invest, to different asset classes that we talked about earlier. Are there any industry tricks that the regular person doesn't know that can be used when allocating assets?
The industry is very, of course, it's a professional space and it's very open. Nobody controls the market really. So placing your assets in the right assets bucket is about mostly your risk profile and your income base as well.
Okay, so let's take this apart. Let's do practical class. There's theory. Now I'm on the practical. Right. All right. I am the risk averse. I'm a risk averse investor.
Oh, interesting.
I want to allocate assets. What do I do?
Okay. And you are okay. Yeah, what age?
Risk averse. I'm 20. I'm 20. I'm 27.
Okay, 27. Okay. So you have more time, right? So in the asset classes we talked about equities, fixed income, alternative investments, and cash.
Okay.
So we have four. So for a risk averse person, the person will have to technically overweight on fixed income. So fixed income in the sense that you buy more T-bills, more government bonds, more T-bills, more bonds, more corporate bonds, investment grade corporate bonds.
Yeah.
So that will make up about 40 to 50% of your portfolio.
Okay.
Now, on the equity side, because equities is less riskier than the alternative investments. So on the equity side, you will be having something
I'm
around.
sorry. Can you? I think that equity is less riskier than alternative investments.
Yes.
Okay, my mind was going to bonds, so I got a bit confused. Okay.
No.
All right, let's
So
continue.
on the equity side, you probably have something around the range of 20 to 30%.
Okay.
So this we've maxed out 70%, left to 30%. On your alternative investments, if you have that cash, because alternative investments most times require more capital base.
So the only alternative investment I know, sorry for cutting you short, is real estate. Are there any others right now in this country that one can go into? Because real estate is expensive. Land is, unless you're buying land in Mowe, and good luck with that. But I mean, real estate is expensive.
Yeah.
So what if I don't have the money for real estate right now? Is there any other alternative investment that one can look at?
Yes, we actually have commodities trading. And even in your real estate, we don't need to buy the whole land. We have REITs in Nigeria. I don't want to advertise any company.
What's a REIT?
Real estate investment trust. Those are, that's REITs.
So what do they do? What are they about?
It's more about breaking, sort of only you buying the land. You can have multiple people come together to buy that land.
Oh, okay.
Or one person can buy the land and slice it and sell to you. So you don't need to have the whole 4 million to buy the land. If you have 500,000, you can own a piece of the land.
That's good. We can't mention any specific rights, because they didn't pay for ad space. I'm just joking. But so rights in general are a good alternative investment, apart from buying land outright.
Yeah, it's a way of owning property without exactly owning everything, but still getting benefits from owning that property.
So asset allocation, right? Risk averse person, right? So you I suppose it's overweight. You are overweighted in fixed income, right? Then you have some equities, some alternative investments, and that's cool.
Cash.
Use
cash. Use cash.
Okay, so when you're looking at even cash as an asset, right? Because people tell you invest because you shouldn't keep cash, sitting in a bank.
Yeah, I
right.
Get that.
So should you? Okay, so now why would you keep cash in your investments as a risk averse person? Now, I know earlier you said, you have to eat. It's who's alive that will invest.
Yeah.
But then is it how much cash, or when should you keep cash and when should you? Because one can say, okay, what if I say I want to separate the amount of cash that I use for my expenses from my investment portfolio? So I know if something is in my investment portfolio is specifically for investment and not for daily consumption. So if it's in my investment portfolio specifically for investments, then why would I want to put a lot of cash in my portfolio if it's for investments?
I agree. But there are some times, like during COVID, the share prices were very low. If you had cash and in those moments, you can enter at very low prices. So cash allows you to take opportunities when they present themselves.
Okay.
Because sometimes you have the money to invest, but the market is not right. And of course, in this waiting, 40 to 50% in fixed income, 30 to 40% in equities, then in alternative investment, then in cash. It's not static. It changes, and you have to do the balancing from time to time. So keeping cash will help you take opportunities as they come.
Okay.
Instead of when you have money or when your salary comes, but this time around you have cash waiting for opportunities.
All right then. How about the risk neutral investor? Right, I'm risk neutral. I want to allocate assets.
Yeah, risk neutral. Okay, 2 ways. High net worth individual, newbie.
I'm not high net worth yet.
Okay, newbie wants to invest. So the way will be to overweight in equities. Equities have more tendencies of giving you higher returns because a risk neutral person doesn't really care about the risk, but the person looks at how much am I going to get out of this.
Okay, but then so equities have a tendency of giving you higher return over what time frame? Because like I know that if someone had invested in particular stocks in, you know, I've heard,
Yeah.
let me put it this way. I've heard that the Nigerian market is not like the US markets where you hear situations where, oh, somebody bought, I was going to say General Electric, but that's a bad choice. Somebody bought maybe Tesla in 2019, right? And then let's say in 2020, 2021, over time it blew up. Or somebody bought into Facebook in like when it launched in the early 2000s, and now their shares are worth something.
Yeah.
I've not heard that is the case in the Nigerian equity market.
No. Well, okay. There have been miracles in the Nigerian equities markets. For instance, if you bought Presco 2022, 2021, it was moving around 100 to 150. Presco now is above 400.
Okay.
That's double.
Yes, but if I'm a novice, I wouldn't know this.
You need a professional. And also, what makes a professional? Someone that dedicated more time to study. So even you can become a professional.
Okay.
But circling back your risk
neutral.
So your risk neutral person will overweight in equities.
Okay.
You can be the same ratio. It's not static. There is no this is how it has to be.
Okay.
But there are benchmarks, there are ranges, there are ways individual makeup come into play in deciding which of even in equities. So if you overweight in equities 40 to 50%. So what kind of stocks should we be buying is another conversation.
Yeah, let's explore that.
Let's explore that. Okay, so if you're overweight in equities, now two things. Are you going to get growth stocks? The growth industries like the energy space. Energy space can be the growth stock. Then talk of dividends, dividend yield, and dividend stocks. You can talk of the banking space. They pay a lot of dividends. Then you talk of the blue chip. You need your
high market cap.
High market cap. You can talk of the
blue chip guys.
The blue chip guys.
Yeah. Okay. Yeah. So does that? So now I like that there are two distinctions you gave: growth and dividend. So basically, growth and income.
Yeah.
Right. If I am being overweight equities.
Yep.
Right. The type of stocks I'm focusing on, will it not have an impact on, or should it be decided by what I want my portfolio to achieve? Now, generally, everybody wants their portfolio to make money.
Yeah.
Right. But I know earlier, even like behind the scenes when we're talking, you said your portfolio can either be capital appreciation, yes, I believe, or income generation.
Yeah. Of course. Why buy shares? You can't get capital appreciation and you can't get dividends.
So do these goals, also apply to portfolios where someone wants to do his portfolio for capital appreciation or for income generation?
Yes, exactly. So it depends on the person. So if someone is comfortable, good salary paying or good business that earns good money, the person might not necessarily tilt towards dividend paying, because the high growth stocks, they promise higher capital appreciation, which means it can go from 50 naira today to 500 in 1 year, in 1.5 years, depending. But the dividend paying stocks tend to be very stable, but they give you regular cash flows, which means if you are middle income earner and you need those regular cash flows, you have to tilt towards dividend paying so that you can still be getting cash flows from your investment without liquidating. And these stocks are dividend paying doesn't mean they don't have capital appreciation in them, just that the expectation that the prices will move significantly is less compared to the growth stock. But the growth stock, coming to that, doesn't necessarily mean they don't pay dividends. They pay dividends, but not as much. So their dividend yield is lower than that of dividend stocks.
All right, now, so for the risk-loving person, so I love risk. I love the adrenaline. What am I investing in?
Oh, okay. Same asset classes, same portfolio composition, but it's the weighting. So you weight more of the alternative investments. If you have the money, you can go for the PE and the VCs. Of course, but they are springing up real fast right now in Nigeria. If you can meet their minimum requirements, you can delve into that. But if not, if you have a smaller capital, you can go into the commodities. You can try the one we have in Nigeria here, the exchange, or you can buy the real commodities yourself. Then on the equities, you can do equities, but by then maybe ETF might not really work for you because ETF can be boring sometimes. Sorry. Yeah. So it can be very slow. So you can delve into growth stocks that can increase, companies are trading, maybe.
Yeah, you said energy earlier, that energy is a growth sector.
Yeah, because of course, the federal government is focusing on energy at the moment, trying to drive up production on the oil side so that they can get more revenue. As they are doing that, the companies in there are making money. And if they are making money, they are channeling more gas to the power space to give more gas to customers, power space to make more money, discos to make more money. So that space is really growing. And also, even in the renewable energy side, that too is a conversation that is ongoing. So that space is fire at the moment. Then you can also look at then less weight on the dividend side because of your kind of person.
Yeah.
Then another step is on the fixed income side. On the fixed income side, you overweight on the corporate bonds.
Yeah.
Even on the junk side.
Really?
Because in there you have higher yield. So a junk bond can give you a higher yield of say 40%. Normal investments, grade-rated bonds can give you between 20 to 30% at the moment in Nigeria.
Okay.
You see the difference. There's a potential upside in there.
But I know that this is risk loving, but that's a lot of risk.
But there's still a level of protection because bonds rank higher than equities. So if you do your valuation and the company you are talking about can actually use those money to get additional asset base and give you something you can hold on to should bankruptcy come.
So now now that we've really ironed out the different risk profiles, let's put some money into this, right? So say I was earning 200K a month, right? And I'm risk neutral, right? So for the sake of time, maybe we won't go into monies into each and every one, but different earning ranges, right? Are there differences in the way different salaries or different income levels apply to these risk profiles? Like if I was risk neutral and I was earning 200K a month, would my approach to building my portfolio be a bit different to if I was also risk neutral but I was earning 1.5 million a month?
Yeah. So that's where let's take the risk neutral I just mentioned. If you have higher earnings, you can buy expensive stocks. Let me not say expensive, but 0.5 naira is way less than surplus of 5,000 naira.
Okay.
So if you have more earnings, you can afford to buy those kind of stock that are growth but are pricey compared to the lower ones that are below 1 naira. You see, that is already affecting the kind of stock you are buying. So in the same risk bracket, risk neutral, right? But different kind of stocks.
So is that basically the only way where equities, people with higher incomes can buy more equities, or does that also affect even the type of assets or the way you apportion, the asset classes in your portfolio?
Asset classes.
Because so for risk neutral now, I remember you said for risk neutral you can go maybe it'll be 50%, 40-50% equities, 20-30% fixed income, and cash. I think the rest was cash. Maybe a little bit of alternative investment, and then cash. So if I earn 200K a month, right? Could it be that I might have been in a situation where the amount of cash I have left over is not a lot, so they might not really be worth keeping cash. So I'll just invest the rest, maybe increase my weighting or allocation of maybe alternative investments or stocks. And then if I have 1.5 million a month, then the amount left over in cash will be a bit more significant. So I can now reduce maybe my equity investments, maybe 45% to have a bit more cash because the cash makes more sense. Things like
Yeah,
that.
okay, I get where you're coming from. Portfolios are not built on a monthly basis kind of perspective. It's built with a long-term perspective, in the sense that if you have 200 and you are to invest in equities, fixed income, uh, alternative investment, and even keep cash, you don't have to do that at once in 1 month.
Okay.
So you can pick one sector for this particular month. This is what I'm investing in. You build that. For the next month, your next salary pay, you build the fixed income leg. Your next salary pay, you build the cash leg. The next salary pay, you build the alternative investment leg. Then at the end of the year, you can take a look at your portfolio and see the one that is high or low. Then depending on risk appetite, you can now decide, okay, so the following year I need to focus more on equities because equities is the least in my portfolio and I am risk neutral and I need more equities.
Oh, okay. Yeah, that makes a lot of sense,
Yeah.
actually.
So you take it step by step.
Because I was thinking, okay, get 200K, 50% 200K,
Ah,
100K, that
no,
would
no,
be
no, if you,
10.
it's part of my diversification because if you must split it, the money will not make sense. The
Okay.
money will not make sense. You take it one after the other.
One after the other. Fantastic. So now let's talk about I've built my portfolio.
Okay.
I know my risk profile based on my earnings, built the assets. I have bought equities for a couple months, bought physical for a couple months, and then it's the end of the year. And I'm looking at my portfolio. What should I be looking for me to say my portfolio makes sense? Not just in terms of my allocation, right? Because anybody can say, okay, if I've allocated 50%, fine, no problem. But what are those benchmarks that will allow me to know that my allocation is working? It's profitable, it's good. I can keep on using this particular strategy and allocation for the next 1 or 2 years.
Yeah. Yeah. Okay. You can do that in two ways. At the end of the year, that's what we call the portfolio rebalancing. Right.
Okay.
In two ways. You can decide to pick a benchmark and use that benchmark to check your portfolio to say maybe Osha index. What did Osha index do? It did 20%. If I put together all the monies I've invested and my costs vis-a-vis my current value, I do my return, is it up to 20%? If it is 20% or more, you can now see if that is your benchmark, you can now see my portfolio performed well and I did my allocations well. Or you had a target rate in mind, say I want to make 30% a year. That 30%, then now weigh all your portfolios. What's the current value? What's the cost I incur to get this portfolio in place and do your returns? So your current value minus your cost, or divided by your cost, that will give you the percentage return of your portfolio.
Okay.
That being said, even if your portfolio performed well in a particular year, probably your fixed income performed well, more than your equities, or your equities performed more than your fixed income. That is not a basis to portion your investment for the next year, because it depends on the economic situation. Right now in Nigeria, NPR is high, yield is high, fixed income is performing well.
Okay.
So most likely, people that overweight fixed income, we get more money. But of course, yields are trending lower now.
Yeah.
That's a different conversation. But assuming the yields are sustained as high as they are, by year end, people that overweight fixed income will smile more than people that overweight equities, assuming the yields are sustained as high as they are. Which means if they are sustained as high as they are by year end, and you see that yields are going to go down, that's a signal that in this coming year, fixed income might not do as well as equities.
Yeah.
Which means your equities will overperform for that particular year. So you have to take into cognizance the economic condition of the country and the policies where we are going to make investment decisions for the next year, bearing in mind your risk profile and your allocation. Don't get greedy. No.
I like that. Don't get greedy. But then does that mean that I might have to what, restructure or rebalance my portfolio every year based on what I feel is going to happen in the economy the next year?
Okay. So if you go to rebalancing, there are factors you consider. This is one of the factors.
Okay.
Another factor is, has your risk appetite changed? Has your risk profile changed? Since you started investing in equity, have you got more comfortable and you want to take in more risk? If that has changed, you can rebalance. And also, have you got more money? Do you still need growth stocks or need dividend stocks? Are you getting married next year? Are you trying to build a house in the next 2 years? So, these are the factors you put into consideration in the investment rebalancing. So if all these factors come in play, for instance, if you want to get married coming year, your family is going to come, you're going to expand, you're going to spend more, which means you probably shouldn't overweight fixed income, because you should tilt towards more the equities that can get you more money that can use to pay those expenses.
Okay.
I know I didn't put in, of course, on the alternative investment side, and I named this, we have Bitcoin, it's a new kind of asset, cryptocurrencies. Cryptocurrencies is big alternative kind of investment.
That's a dicey
one. But it's something to consider.
Okay. All right. So at the end of the year, you have to, look. So imagine I use the risk neutral, risk profile, and it works so well that at the end of the year, I'm now risk low. But I'm like, hell yeah, let's do this. And I restructure my portfolio to a risk, loving portfolio. And the next year it doesn't do well. What happens then?
Remember, you are risk loving. It's about the risk. It's about the risk. So you took the risk, it didn't go so well. Remember, it would have gone the other way. So the satisfaction you got is that, of course, you've explored that option of having taken the risk. But that doesn't mean if you go risk loving the following year that you won't do well. A bad year doesn't mean. So if you do your evaluation and you think, you are still risk loving, and the fundamentals of those assets you invested in are still solid, why not? You're an investor, you're not a trader. You can wait it out.
So before we start landing,
Okay.
what do you think are some of the mistakes? Because nobody's perfect. What mistakes? What are the common mistakes you've seen in the industry or in your career that people make when constructing portfolios or rebalancing portfolios or just building portfolios in general?
Yeah. I think one is not understanding what they need at the moment.
What does that mean?
You are getting married the following year,
Okay.
and you're not taking that into consideration in making some investments, especially in the alternative investment space, that can be locked in for 5 years. And next year you need cash. Or you are in a space, you are at a stage in your life where you just finished service. You need to invest more in getting knowledge, and you put all the money in equities without the money to invest in knowledge that can increase your earning worth or move your business. So you end up getting just little dividends, but that wouldn't grow because you don't have enough capital to reinvest in those spaces. So you need to understand the state you are. The next one will be greed can set in. You decide that you need your investment appetite is 30%. Once I get 30% on a stock, stock is doing 33%. And you're like, maybe you can do 40. Then it's down to 20. So once you meet what you set to get, please get out. And get other things. And also you need to understand your risk profile. You need to understand your risk profile and follow its true. If it changes, changes. But you need to set a period where you rebalance. If not, you can be very dynamic, because for a particular risk profile to pay off, consistency is key.
Yeah.
For instance, if someone started off 2021 risk neutral or even risk averse and overweight on fixed income, if the person will make more money 2021 2022, 2023. But look at 2024 and 2025 when NPI went up. Person would have made a lot of money.
Yeah.
But if the person wasn't consistent, that's another thing. But if your risk profile changes, you need to set a time horizon where you evaluate. Or whichever risk profile you're using, consistency is key. And also, you don't need to have a lot of money to start. It's not built by putting in, a lot of money at once, one step at a time. Consistency, one step at a time. And also, sometimes some persons can say, make it very simple. Simplicity is key.
Okay.
Don't complicate it. It's not complex. No, hold on. Don't make it complex. Simplicity is key. So don't ambiguity and complexity doesn't guarantee higher return. So stick with what you know. Dip your alpha and spread. That's
all right. How about over concentration?
Fine. That's I brought this at the beginning of the conversation because I think I think to build wealth really you need to be known for something, then you branch out. Just have been saying since.
Yeah.
Elon, Elumelu, Dangote, Femi, whatever. So when you mention their name, you know one thing about them. It's where they come from, the sector they come from, that they build the wealth from, and they are spreading. And so they don't have they build a cash cow. You're like getting the money from to invest in other spaces. So you build your cash cow. So even if you don't have a business as your cash cow, you can be your own cash cow. How? Invest in yourself so much that you are getting paid significantly higher than the industry benchmark, and you can use that as a cash cow to invest in other sectors. Because I think the one of the employees of Apple is a billionaire as an employee, so it's possible.
That's Tim Cook.
Yes.
CEO.
Even Tim Cook too. There's another guy, I think in Microsoft. In fact, there are so many billionaires and employees. So you must not have to veer off into entrepreneurship, but invest in yourself and increase your value. That's your own alpha.
Okay. So depth, earlier you called it depth alpha.
Depth alpha, yeah.
I like that term. Depth alpha. All right. Any final thoughts for people, that are just starting out, or people that want to build a portfolio?
Final thoughts. Stay curious.
Okay.
Stay curious. A curious person, keep reading and taking it in. And as you are taking it in, practice. You need to output. If you don't output all those things that are taking in, at the end of the day, it sums up to zero. Because it's the output that really shows. So if you learn something and you believe in it that it's going to work, try it out. But just know that it's not built in one day. It's over time. And make sure you are investing in cash flows, not dead-end investments. Cash flows, something that yields cash consistently or is going to for growth stocks.
Okay, I was about to say that. I like
that. I know you're going there too. So, and also interact. Don't do it to interact. And of course, nobody knows it. In fact, if they are making a prediction on TV and you've done your own analysis, you've done your own analysis, go with yourself. You could be the lucky guy.
Okay.
People that shot Enron, everybody thought he's doing well. Yeah, so that's just read a lot.
I think that's pretty much it. Now of course I'm sure that there are a lot more nuances, to building portfolios.
Yeah.
We're not here to go into everything. I don't think I don't think we can actually, but just to sum it up, and correct me if I make sense. The first is your depth alpha.
Yeah.
Right? I really like that term. I'm going to use that term. Your depth alpha. Developing yourself, getting into the right mindsets, that you're investing long term.
Yeah.
Taking care of any debts that you might have so that you're starting from zero.
Yeah.
And just developing yourself to the point where you have enough money that with a moderate lifestyle, you can still invest.
Yeah.
And then understanding your risk profile. Are you risk averse? Are you risk neutral? Are you risk loving? Setting a time horizon. Ideally, it should be over a year, because if you are rebalancing your portfolio, your portfolio ideally once every year. So, a time horizon. And then going into the asset allocation. Setting your goals also. Do you want, based on what's going on in your life? Are you getting married next year? Do you want to buy a Benz? Do you want to buy a house? Things like that. And she determine whether you are looking more into growth or cash flows.
Yep.
Right. And then you go into asset allocation, and the different asset allocations for the different risk profiles.
Yeah.
And go into that, for your I don't start going into go and watch the video. Different allocations and all. And after that, how even your income range might affect, what you buy, how you buy.
Yeah.
And then going into, maintaining your portfolio, rebalancing, you have your benchmarks, that you can compare your portfolio performance against, and then structure, based on that. And I think that that's pretty much what we've done. We've talked about for building a portfolio from scratch.
Yeah.
So I just want to appreciate you thank you for coming on. I know it has been a long conversation. But if you're watching, this is Sir Emmanuel Gokwe. He is a professional investment analyst with a background in economics and accounting, and he has industry experience with managing portfolios, and that's one of the things that he has done. And he's just here to share his insights. Thank you so much.
Thanks.
For being on the show.
Thank you.
Now, this has been the Market Lens. Interact with us on social media. We're on Instagram and LinkedIn and YouTube. I can check out our content, even our former video that we did before this. And we're going to be making more videos about different financial concepts. Just getting you one step closer to financial freedom and independence. This has been the Market Lens. I'm going to say now hello and stay safe in the markets.